here again seems really unlikely to me. Just one other set of charts. Now, I apologize, these are on different scales. So if you look at the scales, you'll see what I'm talking about. I just want to emphasize to you that on the left is imports, on the right is exports. And Tennessee, just like the nation, is importing a lot more from our trading partners than we're exporting. And a lot of this, of course, is we make a lot of cars in Tennessee, and we're importing a lot of parts that go into those cars as an example of what's taking place. Income-wise, Tennessee remains under the national average, but we're now basically at the southeastern average. And so incomes continue to rise in Tennessee. And while they're below the nation, they're rising faster than the nation. And you can, again, see this. In this case, I'm just showing you Tennessee versus the southeastern states. And our wages are catching up, and Knoxville wages seem to be doing pretty well. One thing that's striking to me is how different the incomes in Tennessee are by county. I don't know if you can read it, but if you can see the Williamson County number there, it's twice Knox County and 3 times a bunch of counties in Tennessee. And so really big differences. Actually, in our area, Loudoun County has the highest per capita income. It's not Knox County. Generally, Knox County would be leading most economic measures, but not as measured by income. So really big variation. Okay, talk about population and what's happening there. So this is population growth. Sorry, I'm going to stand your way now. This is population growth by decade. And, you know, if you look at the last 3 decades, one thing is clear. Population growth in the U.S. is slowing, and population growth in Tennessee is slowing relative to where we were, you know, in previous time periods. So clearly slowing down. So why is that happening? Simple. We're aging, and as the population ages, we have a bigger share of people die. So not here to tell you good news, but we're seeing relatively more deaths in the population. And then add to it, and this is Tennessee data I'm showing you, is relatively low birth rates. Since 2007, birth rates have been declining, and you put these two together, and it's no surprise that what we're seeing is slowing population growth. Now, if you think about it, population grows is impacted by 3 things. It rises with births, it falls with deaths, and then the third thing is, well, what about people coming into the state? What happens with migration? And so here is migration into Tennessee. This is by year rather than by decade, giving you really detailed look at it. And you can see the last 3 years, basically since COVID, a lot of people moving in to Tennessee. And so and those, and you all know I'm not a home building expert. I'm not a housing person. You can see I'm a sort of general economics in this area. But you all are probably seeing the reality of this in terms of demand and so forth. And if we look at by county, what we see is that the migration rates or the population change rates are different. Again, just like with income, radically different. A number of counties, particularly in West Tennessee, where population is literally falling. If we talk about the places where growth is taking place, Knox County is actually number 2 to, I think it's Rutherford County, which has higher population growth in recent years, but otherwise Knox County is second. And again, I'm guessing that you all experience the reality of what's going on there with people moving in to our area. And I thought it was interesting to note that over the last several years, an increasing share of them have been people, let's say, right before retirement. Maybe they're retiring early. Maybe they're coming here and saying, and in fact, I've actually met a couple of people who said, well, I was able to get my company to allow me to move here and finish my career here because this is where I want to retire. And so it's not that they came here per se for retirement, but that's sort of the longer term plan. So I'm going to end by just giving you a few slides on housing. Let me note again, I'm not a housing economist. You all know more about housing than I do. I do know data, so I can show data, but if you're going to get into detailed questions, there are lots of people in this room that can answer them. I'm probably not the one. So anyway, this is housing starts from national data. You can tell I've been around a long time talking about general economic stuff as well as some more precise stuff I work on. And I remember during the Great Recession, my comments were, well, when housing turns around, that's when the economy will really begin growing again. And guess what? We had the Great Expansion, or the period after the Great Recession, without housing really turning around. We were nationwide building sort of 2 million houses a year before the Great Recession, and it slowed down to 1.2, 1.3 million around the country. And we never really came back. Things are again moving slower. I suspect Dr. Dietz will talk about that kind of thing in much more detail. To turn to Tennessee and the local area a little bit more, you can see in terms of monthly building permits, the data, because they're monthly, are pretty volatile. But all months in 2025 are lower than 2024. So we're seeing some declines this year relative to last year. If you do it by MSA, all of these metrics, what I've done is I've compared the number in 24 to the number divided 25 by 24. All of them are lower than 1. That tells you it's fallen this year, and the lower, the more it has fallen. Knox County turns out to be the best of places, all of which are seeing fewer building permits than a year ago. Okay, and then I think maybe I have 2 more slides. This is just pointing out that in terms of active listings and median days on the market, things are moving back to more kind of normal pattern in terms of Tennessee. But again, recognizing that things like housing starts are slowing down. And then the final chart I had to show you is just that prices themselves are, while still going up more slowly than in the past. So let me just conclude by saying that, again, Tennessee's doing well. Our economic growth continues to be among the best in the nation. Knoxville is, I'm at UT, and let me say, Knoxville is doing really well. And a big part of the reason for that is UT is expanding like crazy. When Donnie Plowman came here, we had 29,000 students. That was 2019. Today, we have something over 40,000 students. And with those 40,000 students go, well, and maybe some of you are involved, housing everywhere, right? And all the new apartments that have been added, we've added 3 new dorms recently. I think we're going to add another one over the next year or so. We'll actually put out another P3 on that. The new apartment buildings along Cumberland that have sprung up, and my office looks out at Neyland Stadium and at all those new apartment buildings just across the Tennessee River there. I have a wonderful view every day of watching them build them. UT is a really big part of that, but also with the students, faculty and staff, and a whole range of other new construction projects, including what's likely to be a new hotel at the south end of Neyland Stadium. As you may have heard, Danny White is arguing for adding 16,000 more seats onto Neyland Stadium. He did a presentation to us the other day on the details of what this will look like, and they're able to do it without making the stadium higher, but the north end will all be at the same level as the skyboxes. And so it's going to be kind of the same height all the way around. Again, the construction phase of what's going on is huge as well. Well, thank you very much. It's my privilege to be here, and I guess there may be some time for question later if you have it.
Thank you, Dr. Fox. That was incredibly insightful and educational. I think we could all listen even longer. Hopefully, we will have time for Q&A after for both of our speakers. Now I'm going to hand it over to Dr. Robert Dietz, who is the Chief Economist, Senior Vice President of Economics and Housing Policy with the National Association of Home Builders. Dr. Dietz is just said that part. His responsibilities include housing market analysis, economic forecasting, industry surveys, and housing policy research. Prior to joining the NAHB in 2005, Dr. Dietz worked as an economist for the Congressional Joint Committee on Taxation, specializing in revenue, estimation of legislative proposals involving housing, urban development, and other business tax issues. He's a native of Dayton, Ohio, and holds a doctorate in economics from the Ohio State University. Please welcome Dr. Dietz.
Thank you very much. It's great to have the HBA invite me to have the state leadership here. I thought I was going to avoid the Ohio State University thing. I think Dan, has heard the story before. I did the State Association of Michigan this summer. When I got invited to the stage, it was all booing before they even heard the forecast. But I think you're going to kind of hear a kind of a similar sort of outlook and lay of the land that you heard from Dr. Fox. I think these things usually are a little more interesting when you get kind of the dueling, fighting economists. But what I'm going to do is a three-part presentation. The first part is going to look at macro and a little bit of demographics. Then in the second part, we're going to look at some of the factors that on his slide, that sort of failure to get the full rebound in single-family home building, we'll look at those factors, things like building material pricing, the labor shortage that's affected our industry, and maybe how the interplay with policy is affecting those particular items. And then in my last section, I'll give you our forecasts. And then maybe we can do a little bit of kind of joint Q&A between the two of us, kind of see if there are any kind of differences. So the big thing is next year's looking a little bit stronger than this year. And it's in part due to the fact that the Federal Reserve has begun to ease again after what was kind of a long pause after we entered into 2025. The 2025 as a whole has been somewhat of a disappointment. You're going to see that in the single-family home building statistics. The two primary reasons we've seen kind of a lingering malaise, kind of a wait-and-see economy in 2025 is ongoing elevated mortgage interest rates. We'll get to that. And then the second thing I think that was unique about 2025, and I pulled this index from a couple of academic economists, there's just a lot of uncertainty for households and businesses making major decisions. So this could have been business investment. It could have been a home buyer choosing to buy a home, remodel a home. And what you can see here is the uncertainty really spiked during COVID. Of course, during COVID, in a lot of parts of the country, state and local policymakers were kind of making up laws and rules as they went along. We didn't really know what the rules of the road were. You could probably make the argument, but we went a little overboard when it came to policy during COVID. But look at 2025. I mean, this is a lot of uncertainty. And as a kind of a free market supply side economist, I'll give you the reason for that uncertainty. A lot of the kind of issues around tariffs, particularly the Liberation Day announcement in April really drove the uncertainty levels for businesses. Now, we can have a debate over the kind of the long-term effects of tariffs. Are they one-off effects, persistent effects? But they changed the rules of the road and created that kind of wait-and-see environment. The other thing is that some of the strength in the economy has been AI investment and the consumer. And what we're starting to see is some weakness built into consumer finances. So this is seriously delinquent loan rates. So you can think of these as loans that are more than 90 days overdue. Mortgages here in red, they're actually in pretty good shape. There's no systemic risk right now emerging from the housing market like we saw 15 years ago. In fact, I remember saw a New York Post headline that said mortgage delinquency rates had doubled. Yeah, they had doubled, but from virtually zero. It didn't take very much to get that kind of doubling. But it's these other loans that we're kind of more concerned about, the strength of the consumer, the sort of the economic health of the consumer. You can see that in the green, auto loan delinquency rates rising. That's the one I actually look at the most, because you've got more and more 7 and 8 year car loans. You know, the interest rates are higher, and you can see that green line going up. Credit card delinquency rates, you know, a year ago, average credit card rates were in the 20% range. Think about that. If you know, people carrying a balance with the 20% interest rate. And then you can see the one in blue, student loan delinquency rate. So we kind of went on vacation in terms of, you know, some of those folks not having to pay their loans. Well, time to be an adult, pay your student loans. You can see what happened. Not only did that delinquency rate go up, but it's actually higher than it was at its peak rate in the years after the Great Recession. So that is going to have some lingering weakness in the rental market and the first-time home buyer market. In terms of GDP growth, and some of this is going to kind of overlap with some of the prior slides, but you know, we started the year with a negative quarter of growth. That's somewhat an accounting effect. Basically, there was this rush of imports into the U.S. before the tariffs took effect. Just the way the accounting identity works, imports subtract off from GDP. So if you kind of got a bounce back in the second quarter, if you kind of merge these two together, it's pointing to what we think will be the final GDP growth rate for 2025, which is a 2% growth rate. The economy is growing at a good, not great rate. I would like to see it growing closer to 3%, given some of the other kind of positive factors that are in there. But again, I think tariffs in particular are kind of having this kind of drag effect on overall growth. We do think it is going to improve as we move forward. In fact, 2026, we've got it at a 2.2% growth rate. And I think the Federal Reserve's projections that came out yesterday had it even higher than that over the next 4 quarters. So the big thing that's going to help going into next year, the extension of the 2017 tax cuts. And particularly, I think a lot of people are going to find a little bit of a surprise in March and April. Their tax refunds are likely to be higher because the Treasury Department did not correctly adjust the withholding tables. So relative to the rates that were essentially extended, they may find that refunds are a little higher. That could help consumer spending next year. So we think the chance of recession right now over the next 4 quarters, 30%. In any given year, it's about 20%. So it's just somewhat elevated. I actually just last week did a presentation with Mark Zandi. He thinks the chance of recession risk right now is greater than 50%. That's not uncommon with a lot of macroeconomists. They're kind of in this kind of doom mode. I think it's somewhat overwrought. There are definitely risks, drag factors, but the economy is growing at a good, not great rate. And you know, again, one of the reasons that we've seen some strength, and yes, you can make the argument that there's some froth and there's going to be some businesses that will fail. But overall, if you look at data center and AI investment, it's tripled over the last couple of years. And the reason I say there's some froth, when you start to see, and you hear this on Wall Street, cyclicality, basically business A invests in business B, and then business B invests in business C, and then business C invests in business A. That's not a particularly healthy cycle. That's kind of what we've got in the kind of the AI world. But you know, some of this is going to lead to productivity gains. We certainly do need more kind of data type investments, and that is really generating some strength in terms of the overall economy right now. Labor market, 4.4%, the current rate, as was mentioned in the prior presentation. The other thing I tend to look at, and we do think the unemployment rate is going to rise, probably up to about 5%. You know, you can see the headlines, hiring freezes, layoffs among larger companies as they try to realize productivity gains. But this is not a particularly big rise. And that, again, that's kind of coordinated with the idea of not a particularly large recession risk going forward. But it's this blue line that I've actually been watching since the Great Recession a little closer. That's the job openings rate. And so you can think of the job openings rate as the measure of open, unfilled jobs in the U.S. economy. It's basically the number of help wanted signs that are up at any given moment. You can see it, for example, going down during COVID. It absolutely spiked here in 2021. The reason for that spike, you basically, the return to work after the COVID shutdown. In my neighborhood in Northern Virginia near the Pentagon, this was the period of time where McDonald's were offering $5,000 signing bonuses. They were that desperate for workers. And then what happened? This line peaks. And in fact, at that peak, there were 12 million open jobs for the U.S. economy. And at the same time, there were only about 6 million unemployed individuals, which is a striking statistic of how tight the labor market was. You literally could have taken every single person who was unemployed, put them into one of those 12 million open jobs, whether they were trained for it, whether they were going to show up for it in 3 weeks, and there still would have been 5 to 6 million open positions. So to the Federal Reserve, that's a really tight labor market. It risks inflation. So what did the Fed do? Of course, in 2022, they raised interest rates. The cost of capital went up. And so the result is the number of help wanted signs came down. And that's by design. That's what the Fed was trying to do, was cool off one potential source of inflation, so that number of job openings has come down. So the labor market has cooled somewhat. And again, that's by design in terms of monetary policy. This is very similar to a slide that you showed. I kind of like to kind of measure it relative to February 2020 peaks in terms of local labor market data. So the way you read this, where it says 105% right there, what that means is the U.S. economy has experienced 5% job growth relative to February of 2020. And of course, all the measures show this kind of dip in COVID. It typically took 1 or 2 years to kind of recover those lost jobs. But the numbers here are outstanding. You know, at the state level, 8% job growth. And look at the Knoxville MSA. I mean, 12% job growth. I do these talks every week, in a different city every week. This is one of the highest in the country. I mean, these are really outstanding numbers that are a good basis for housing demand, both rental and for sale housing demand. And in fact, we always kind of try to characterize this and rank it by state. So you got the state postal codes. You don't want to be doing business in one of these states in red. I mean, it's kind of remarkable, but those states, including the District of Columbia, it's been 5 years. They still have smaller labor markets than they did in February of 2020, before COVID. So they've never recovered the jobs that were lost. On the other hand, the leaders, and this is definitely kind of the case, state by state, the kind of the two that stand out, Idaho and Utah, 13, 14% job growth. They have some of the fastest home building markets. And so, yeah, those job numbers really do correlate pretty well with the strongest markets. There's Tennessee. You can see some of the other leaders in terms of home building growth generated by really strong job growth post-COVID. The inflation environment, right now the inflation rate measured by the CPI, which is technically not what the Fed targets. They target something called core PCE, but it's at a 3% growth rate. This is one of those slides that, depending on your politics, you can probably tell the Democratic story or the Republican story. The Republican story is that, generally speaking, inflation is trending lower. The president makes this argument. And, you know, you can kind of eyeball this. The trend line is moving in the right direction. The Democratic story, maybe some of the Federal Reserve economists, is that tariffs have maybe re-accelerated inflation. Well, if you look at this last dip kind of up here, you can kind of tell that story too. So I'll leave it to you which story you want to tell. But generally speaking, 3% inflation rate, we're getting closer to the Fed's 2% target. But here's the housing angle to this. This is separate from the macro story. The Fed wants us to get down to 2%. And you can see we made progress after hitting a 9% growth rate after COVID. That was the highest inflation rate in 40 years. The reason for it, by the way, we pumped $8 to $9 trillion of stimulus into the U.S. economy after COVID for what was maybe a $1 to $2 trillion event. So all that excess stimulus caused all prices to go up 30 to 35%. So you would say, okay, well, we should have gotten down to the Fed's 2% target, but it kind of looks like we stalled out. Why did we stall out? The answer is really simple. It's housing. It's the red line. It's shelter inflation. Shelter inflation is rent and homeowner costs. It's driven by higher construction costs. And so when I'm talking to policymakers in DC, whether it's my counterparts at the Federal Reserve, going up to Capitol Hill, to policymakers in the executive branch, we make the argument that if we want to land this airplane and get down to the Fed's 2% target, there's only one way to do it, and that's essentially to provide more housing. more attainable housing for sale, for rent. The demand side, Band-Aids, stupid ideas like rent control aren't going to do it. It's a supply side problem. We need to add more supply. So that's our consistent message in Washington. And by the way, our allies at the National Association of Realtors, the Mortgage Bankers Association, the other housing groups, we're all on kind of the same page on this, focusing on the supply side of the market. So as a kind of a mathematical exercise, shelter inflation right now is 3.6%. For the last 2 years, more than 50% of the growth in CPI has been shelter inflation. It's not all these other things we talk about, tariffs and service sector. It's all about housing. It's the housing deficit. It's the lack of building that he showed you on that housing start slide coming out of the Great Recession. All right, so where we stand with the Fed? Well, the Fed reduced the rate that it targets, the Fed funds rate, by 100 basis points at the end of 2024. And then they went on pause until September of 2025. The most common question I get as I travel around talk to builders was the Fed being political by stopping cutting rates when Trump assumed office? I'll give you my honest answer here. I don't think they were being political, but it sure was naive to think that it wouldn't look political. So I think they were sort of kind of in this wait and see approach to see what tariffs were going to look like. But the result of this was it looked political. I think they recognized they made a mistake. But the good news here is they cut again in September by 25 basis points. They cut in October. And then just yesterday, they cut again for a third time. Now, that was, and you probably heard this language on business news, kind of a hawkish cut. You know, it's going to be harder to cut going forward. In fact, there are risks to both sides of the sort of the equation for the Federal Reserve, because if they cut too quickly, and this is something I would beg of the president to sort of study a little bit. If they cut too quickly, it will convince bond market investors that they don't care about getting down to a 2% inflation rate. And the result then is that the long-term bond investors will say, oh, you know what? They don't care about 2% inflation rate. They're basically saying 3% is fine. And so long-term interest rates will go up because those long-term investors will need a premium to compensate themselves for future inflation. So I'm an advocate for continued easing, but in a very orderly way. I think if we go too quick on the way down, we're going to pay for it through longer mortgage interest rates. But in the meantime, these cuts in the Fed funds rate have direct benefits for the building industry. They push down on a one-for-one basis construction and development loans, and they help keep lower interest rates on HELOC loans for remodeling demand. So that kind of easing is good. Generally speaking, we think next year we will get 1 to 2 cuts over the course of the year. I think we'll probably look at the next one sometime in the spring, so we got a little bit of a pause, and then one final one in 2027. That's kind of, you can see the stair step way down on the red line. But the rate that we care about on the demand side of the market is mortgage interest rates, not determined by the Fed, at least not directly. It's determined by bond market investors. Right now, it's about 6.2% on the Freddie Mac weekly survey. This is one of these kind of misleading sort of forecast windows. It looks like kind of the smooth decline. It's not going to be smooth. This is going to kind of go up and down a lot. But generally speaking, we do think it is going to trend unevenly and grudgingly lower. And by the time we get into early 2027, the good news is we might see 30-year fixed rate mortgage 5.95, 5.9%. And our consumer survey research indicates you get a disproportionate amount of demand coming into the market if mortgage interest rates start with a 5. So, you know, sort of we're going to get better housing demand as we move closer. 2027, we're going to have to be patient in 2026. And then the other risk on mortgage interest rates, you know, the Fed has been the bad guy, although from the Economist point of view, they're doing an important role of draining liquidity out of the system. But the bad guy going forward for mortgage interest rates, not the Fed, it's fiscal policy. It's the government's debt and deficit. The blue line here is the debt to GDP ratio. It's right around 100% right now. This is taken from the CBO projections after the tax policy extension. This debt to GDP ratio is going to go up in the years ahead. And there's some research that indicates for every 10 points, this goes up. So, for example, from 100 to 110%, there's upward pressure on mortgage interest rates by about 20 basis points. Now, the way that works is basically the Treasury has to pump out more Treasury bonds to finance that debt. They've got to attract investors. The way they attract investors, pump the interest rate up a little bit. And when that interest rate goes up, then the bonds that come out of Fannie and Freddie, which are mortgages, have to go up by an equivalent amount to clear the market, and the result is higher mortgage rates. So from an advocacy point of view, what our industry needs to do, what our lobbyists need to do in DC is really advocate for, not reducing this line. I'm under no kind of illusion that we're going to get a cut in the debt to GDP ratio, but maybe just shallow it out a little bit. You have government spending growing at 1% with GDP growing at 2%, and that would cause this line to shallow out. That would be good for mortgage interest rates. So can't keep that in mind in terms of going forward in terms of fiscal policy. And God knows there's room to cut here. This is nominal government spending, so it's not real. It's not inflation adjusted. But if you look at kind of the pathway and kind of ignore the stimulus here, but right now, nominal government spending is 48% higher than it was pre-COVID. So I know we went through the DOGE effort, which was kind of chaotic. It was sort of done kind of, on the fly. But there's room to cut, and my hope would be the second part of the Trump administration really kind of looks at government spending strategically. The other side of fiscal policy is tariffs. I already mentioned I'm not a big fan of these. The big tax cut, I think they're poorly timed. I think they're poorly designed and poorly targeted, and they're huge. This is tariff revenue going up to about $300 billion a year, roughly about $3 trillion over the next decade. The average tariff rate for the U.S. before essentially Trump 1.0 was about 1 to 2%. It's right now closing in at about 18%. These are enormous tax increases that will filter through and have impacts in terms of economic growth. So again, the future tax policy, tariff policy is a little uncertain because we're going to have to wait for the Federal Reserve and how this is going to play out. I think even if the Federal Reserve throws out the first round of tariffs, the administration is going to use another set of toolboxes. So tariffs are not going to go away whether I like them or not. This is a kind of a fundamental principle for the Trump administration, but they are large and affecting that outlook. And then, we talked about interest rates, but prices, just kind of another way of looking at kind of some of the local data here. But this is price growth since COVID, 88% gain in local home prices compared to 55% for the U.S. A lot of strength in the local market, but this is a risk factor. And in fact, in our home price forecasts, we think most markets in the country are probably going to experience 1 to 2% price declines over the next 12 months because the price to income ratio in the U.S. used to be 3 to 1. Today it's 5 to 1. So if you hear some guy, bought his first home in the 70s, like my dad, says, what's the big deal with a 6% interest rate? I bought at 18. Price to income ratio in the 1970s was less than 3 to 1. It's 5 to 1 today. Have a little sympathy for some of those young folks, but this is a risk factor going on. The market has gotten out of whack. In the meantime, the homeownership rates declined. Actually, some data came out earlier this morning, showed a little bit of a tick up, but we are watching this one. The homeownership rate for the Knoxville MSA is 66%, so it's right around the kind of the national numbers for this, but we are worried about some weakness because of the fact that down payment requirements are crowding out a lot of potential home buyers. Population growth, we already talked about that in terms of job growth, so I'm going to skip that one. And then one last thing on the demographic side that we're watching, which is we talk about the fact that we underbuilt housing. There's a housing deficit nationally. We think it's about 1 million homes. Some people say it's as big as 4 million. The common question is, there's a housing deficit. Where are those people living? Well, frankly, a lot of them are living with their parents. They're living on their parents' couch. In fact, if you go back to the year 2000, 1 out of 10 roughly young adults, 25 to 34-year-olds, lived at home. Today, it's closer to 1 out of 5. So that rate has doubled due to the fact that we underbuilt housing. And then, we talked about birth rates and sort of the labor force participation rate. It's been a while since I was in the dating market, but if you're living at your parents' home, it's probably harder to get married and have kids. So the fertility rate in the U.S. has dropped to 1.6. The vice president talks about this a lot. So again, another kind of housing angle. I talk about this a lot in DC, which is if we care about the fertility rate, we care about these young people forming households and doing all those typical adult life cycle milestones that are really important, we need to build more entry-level housing to reverse this particular trend. All right, supply side and then our forecasts. Right now, building material cost growth is running about 3% year over year. Lumber is the one I watch a lot. Now, I was saying 18 months ago, I thought lumber prices were going to really increase. And the reason why was because I was scared of tariffs. That has not happened, fortunately. I'm happy to admit I was kind of wrong on that. But, you know, if you look at lumber prices, they're kind of flat to where they were a year ago. But here's where the risk factor is for lumber over the next 12 months. Building was down in 2025, so the demand for lumber was down, but in the meantime, the tariff and duty rates on lumber, Canadian lumber, which is a quarter of our lumber supply, comes from Canada. At the beginning of the year, it was at 15%. It has now increased to 40%. So the tax rate on imported lumber, a quarter of our supply, went up to 40%. That is going to affect the market next year. So I'm going to kind of double down on my wrong forecast from last year. Lumber prices are going to go up next year. Keep that in mind in terms of your own kind of business budgeting. Labor shortage, this is the job openings rate just for the construction sector. You see the number of help wanted signs in construction went down 2025. That's because building levels went down. A little easier to get a construction crew right now than it was 18 months ago, which is kind of remarkable because the other discussion item on the labor side is, of course, illegal immigration. So what we did here is this map is the share of the construction labor force that is non-native born. We're not saying legal versus illegal, documented versus undocumented, but just non-native born. It is kind of remarkable. You see the kind of the high cluster areas, kind of gateway parts of the country, Texas, Florida, California, New York, New Jersey. But overall, nationwide, roughly 1 out of 3 construction workers was not born in the U.S. So obviously, any kind of enforcement on illegal immigration is going to have an impact. I put the top occupations where you can see really high immigrant shares. And again, as I've kind of traveled around, we tried to figure out how much immigration enforcement actions are affecting our industry. So this was kind of interesting. Usually when economists are getting government data, you know, we download it. We got this through a FOIA request. It was almost like doing detective work, trying to get the number of ICE arrests by state. Then we took that number and divided it by the population of each state to kind of try to identify the places that had the highest intensity of labor force enforcement. And, you know, it's kind of, again, interesting. You see Texas, you know, a lot of states in the South. The reason for this appears to be twofold. I'm still kind of working on trying to prove it, but these are my 2 guesses. One, local politicians were willing to coordinate with Homeland Security. And 2, if you're closer to an airport where deportation takes place. So I particularly saw that in Louisiana, for example, where there are multiple airports. If you're a bus ride away from one of those airports, there's going to be more ICE enforcement. But going forward, we do expect this to spread out through the rest of the country because the big, beautiful bill had $55 billion in immigration enforcement. So this is going to spread out as we move through. And then also on the supply side, this is something we talk about all the time. The reason we haven't built enough housing is these regulatory costs. This is some unique research that my team does by surveying land developers and home builders every 5 years. The next survey, by the way, goes into the field in the next few weeks. So this is the 2021 data. But what it finds is when you stack all these different costs that go during the land development process, the construction process, what you found in the 2021 data is about $94,000 of taxes, fees, delay costs, red tape costs, building code requirements that customers don't want, but regulators have imposed, design standards, land that you can't build on. You know, you just go on and on and on. And so the result is that about a quarter of a typical newly built single-family home's purchase price is made up of these regulatory costs. In fact, I'm pretty proud of this research because in President Trump's day 1 executive orders, there was one on reducing the cost of living for ordinary Americans. That executive order cited one number, and it's that one right there. So the administration is listening to this and is looking to, during, again, the second part of Trump 2.0, to bring this regulatory burden down. This is exactly what Dan was talking about in terms of efforts at the state level, efforts at the federal level. That's what your dues do in terms of advocacy actions, and we're trying to bend the cost curve in the right direction, which will then have beneficial positive impacts, as I mentioned earlier, in terms of demographics and entry-level construction. And just as a reminder, you know, you're members of the local association. Those of you who are not members, please consider joining. You're members of the state association, the Home Builders Association of Tennessee. You're also members of NAHB. And NAHB has about 100 lobbyists, lawyers, and regulatory experts. These are kind of the 10 large items that are working for you in Washington, on Capitol Hill, working in the White House, and the executive agencies. In fact, we just got 2 wins recently. We're going to get a new Waters of the U.S. rule that defines what clean water permits you have to pull out, and they're going to redo the FHA mortgage buyer building code requirement for entry-level construction that was really jacked up at the end of the Biden administration. They're going to redefine that one. So these are good wins. More are coming that we expect from the administration on the regulatory side. All right, I'll wrap up with our forecast and then happy to take questions. Multifamily construction was down a lot last year. It's got a little bit of a bump up, mostly in rural areas this year because we got a lot of frustrated home buyers who continue to rent. Locally, flat data for apartment construction. We think that kind of flat trends are going to continue. And then this is the big one that we forecast. This is kind of the money slide here for my presentation. Single-family housing starts, we think are going to end, as I said, a disappointing year, end the year down 6-7% or so. Nobody laughed, 6-7. Yeah, my kids. We're going to be down about 6-7% on single-family housing starts. We think we will grow next year. Accelerating growth. This builds on kind of the tone that Dan mentioned. Accelerating growth as we go into 2027. More growth in 28, more in 29, and more in 2030 because of that housing deficit. So you can kind of just imagine this kind of growth line going forward. We're back on the growth trend line that we were on before kind of the COVID era disruptions. We think that will continue provided the supply side cooperates in terms of getting the workers we need, regulatory help, building material supply chain protected, and the like. The local data, yeah, just kind of a similar slide that you saw before, but the Knoxville MSA single family home building, not bad relative to the country, just down roughly about 3% relative to last year. Statewide down 6%, again, a little bit better than the nation as a whole. I travel every week to talk to markets. These numbers are not bad for 2025. Most markets are down. Like I was just in Florida, you can see markets down 10, 12, 15% relative to where they were in 2024. And then if you're interested in the biggest markets by volume, I'm a Big Ten guy. I grew up in Ohio. I gotta say, even as a Big Ten fan, it's pretty heavy on SEC markets here. So you got Texas, you got Florida, Nashville's in the list here, but more than 50% of home buildings in the South. That trend will continue because that's where the population growth and the job growth is. So Houston and Dallas are the kind of the two big ones here. That last year they built 100,000 homes. The entire state of California in 2024 built 60,000 homes. In fact, you know, I get asked every year at the Builder Show by this journalist from California how California home building is doing. My answer is like, yeah, California home building is doing great. They're building lots of homes. Problem is they're building them in Nevada and Idaho. That's too expensive to build in California. That's why they're losing congressional seats. So there's a reason this is really heavy on southern markets. That's where the growth is. Good place to build, including this market here. And then custom home building often doesn't get discussed. This is building on an owner's lot. So you don't see this in the new home sales data. It's about 20% of the market right now. And in fact, custom home building is higher this year. So where we've seen a retreat in home building this year, spec building, biggest national builders, custom building, the higher end of the market. These are buyers that their housing demand is more correlated with the stock market than the interest rate cycle. This market is up this year. And we expect a little bit of growth next year. And then lastly, remodeling. I am really, really, really bullish on the remodeling market. In fact, we did at the NAHB meeting in Denver, Dan was there, a 10-year estimate of the remodeling market. We think the remodeling market over the next decade is going to grow 30%. And the reason why, aging housing stock, the typical age of an owner-occupied home in the U.S. is about 41 years old. Aging in place, the population aging that Dr. Fox mentioned, in terms of lots of home equity, not everyone's going to move to the villages. They're going to age in place and reinvest in their homes in terms of resiliency and energy efficiency, and all of that means outsized growth for remodeling. So think about that in terms of your small building company. You probably want to look into tear down construction or remodeling construction as growth areas over the next decade. And then lastly, it's kind of the last slide. I always kind of include this one, which is the demographic profile of the U.S. Demographics is destiny when it comes to housing economics. So you kind of got a set of ages here. So I'm right around 50. I'm a Gen Xer. There's not a lot of us Gen X folks. We're the Jan Brady of generations. Gen Xers would get that. The millennials, lots of them. As those millennials age in their 40s, the demand for single-family homes is going to grow and grow and grow. That's why the housing deficit exists, because we haven't built enough for those particularly younger millennials. If you're a doom and gloom type person, let's look at Gen Z, smaller. And then if you look at kind of today's 15, 16-year-olds, the profile kind of drops off. And the reason why is the fertility rate after the Great Recession 15 years ago went down. Why did it go down? Because we didn't build entry-level homes. So the marriage rate went up, the birth rate went down. And then if you're really kind of concerned, look at Gen Alpha. Gen Alpha is the smallest generational group in more than a century in the United States. In a couple of years, we get Gen Beta being born. By the way, Gen Beta is the worst generation name I've ever heard. It sounds like a bunch of losers. So they're going to come up with like a millennial type moniker. But, Gen Beta could be smaller than Gen Alpha. So if the vice president is concerned about this, J.D. Vance has talked about this a lot, and he wants to reverse these demographic trends, the argument I've been making in D.C. is build more entry-level homes, or help us build more entry-level homes. The government should build them. Let us build them and do that through improved regulatory and tax and business policy. So with that, I want to thank you very much. The QR code will take you to some economic resources. ionhousing.org is our economics blog. You can subscribe to it by email. And I'm happy to take questions. We can pose them to Dr. Fox as well. But happy to take questions on the macro, housing policy, anything I may have skipped. So just throw a hand up in the air if you have a question. Yes, go ahead.
I have a micro and a macro question.
Okay.
So I guess I'll start with.
Yeah.
The micro.
We
I feel like-
both kind of chip in.
I feel like you can answer this one as well.
Yeah.
There's been a lot of talk, a lot of articles. I think New York Post came out with one that Knoxville specifically might be booming next year.
Okay.
It seems that Tennessee continues to boom, but is there something specific? Obviously, it's a great place to live. I don't plan on leaving. Weather's nice, people are great. But there's something about Knoxville specifically that is aiding this boom besides the university?
Let me give you a speculative answer, and then we'll go to the real answer, because you're an expert in this market. One of the areas where we see outsized growth for the next 5 to 10 years are areas that are a little colder than Texas and Florida, because we see a lot of investment in data centers and AI, and heat management is a big part of that. Areas that are near big universities, because you need educated workforces, and areas that have a lot of business growth. Check, check, check. That all describes this market. It describes Columbus, Ohio, Indianapolis, Kansas City, those kind of middle, northern, southern type markets. That's where we see a lot of outsized growth. Some of the prior fast growing areas like Texas are going to grow a little bit slower because they've already essentially had their run. So if you want to agree or
So I don't think I'd describe Columbus, Ohio as a little bit colder.
And I also grew up in Dayton.
Oh,
So,
that's funny.
yeah. Hey, you're from Dayton area too?
So what's going on here? I'm on the Industrial Development Board for Knox County. And, I'm sitting in these meetings every month as we're talking about things coming to Knoxville. And the reality is there aren't big things coming to Knoxville. It's not like there's some big employer that's coming here. Where I think the growth is coming is just as you already know, first of all, the university is a really big part of what's taking place. I mean, you had 12,000 students and 5,000 more workers and so forth, plus all the construction. That's a lot of things. Secondly, I think where a lot of our near-term future might be is in nuclear related activities. A lot of construction going on in the Oak Ridge area, but both UT and the Chamber are looking at expansions that are focused on technology oriented. Being near a big university, being near a national laboratory gives us a unique opportunity to bring in that kind of nuclear growth. And so a lot of prospect there. And then the third thing I'd mention is I kind of mentioned in my presentation, is we're getting a lot of people who look like they're retiring here. Maybe not quite, not 68, but 62 or 58 coming here. I think this is likely it. Our topography doesn't lend itself to large, particularly manufacturing employers. We don't have the space in Knox County for it, and, the Industrial Development Board, we manage some industrial parks, but this is small potato stuff. And, there just aren't flat spaces, but there aren't in the surrounding counties either. And so our growth is likely to be more service-oriented type things and retirement-oriented.
And the macro question I have, and thank God we're out of Dayton, Ohio, by the way.
They say that the Wright brothers invented the airplane to get out of town.
I wasn't there when that happened.
I've been in, my background's in the financial industry, and debt gets talked about all the time, and no one seems to have an answer that it's gonna get. It's just, it seems like the answer always is, well, we're just going to push that down to the younger generation. Is there anything coming in? I guess, I've heard maybe the tariffs might help. Sounds like that might not be the case. Is there anything in the future that might slow that down a little bit?
I pity the person that gets elected president in 2028 because they're going to have to deal with Social Security and Medicare, which probably means adjusting, and this better than I do, adjusting some of the FICA tax rules, maybe getting rid of the income cap. We're going to have to do a combination of benefit cuts and tax increases. They're going to be unpopular because the current debt path is unsustainable. And I think it begins to affect the real estate market. It goes from a theoretical concern to an actual impact. 2030, 2031, as long-term bond investors get nervous.
But the only thing I'd add to that is he talked about shallowing out the debt issue without addressing Social Security, Medicare, and Medicaid. You cannot shallow it out. It's there. I mean, we saw in the Doge thing, there's a lot of rhetoric, but there's no money. The money is in Medicare, Medicaid, and Social Security, these entitlements. And without touching them, it just gets to be a worse of a problem. And it's a political problem for the rest of the Trump administration. But then, as you say, the next president's in an even worse position.
And as from a housing industry perspective, as I said earlier, we've kind of said, that's not a housing issue. It is going to quickly become a housing issue. So, we have on our books that we advocate for a balanced budget. Okay, well, there's been a balanced budget since the 90s in Washington, D.C., but we are going to have to get involved in these debt issues because that stack of debt is going to drive mortgage interest rates higher. And it's going to be a real challenge by the time we get into 2030.
That last slide you put up with the demographics, this may sound a little morbid, but the baby boomers are a pretty big bubble in our demographic pipe.
Yeah.
As they start to, we'll just say exit the market.
Exit the page left. Yeah.
Wait, if I can say that.
Yeah, I wanted to see if I always throw a bunch of extra slides in. And I wanted to see if I included the fall off in the, I don't think I did. So one of the issues there is that household formation rates are going to drop. So in 2031 or 2032, it is likely going to be the case that you can see single family starts. Let me back it up to that one. There it is. So as I said, I think single family starts probably going to head up to about 1.2 million by 2030. Then in 2031 and 2032, there's a smaller number of households being formed. Moreover, there's the resale inventory from the baby boomers coming back in the market. That's sometimes called the silver tsunami. I think it's somewhat exaggerated. Boomers are not going to all put their homes to market the same day. In fact, if you look at home ownership rates, the home ownership rate for people over age 65 is 85%. It's the highest by any demographic by far. So what it does mean, though, is in the 2030s, single-family home building is going to change in its composition. There's going to be less master plan community building by the time we get to 2035. And there's going to be more tear-down construction, more infill construction, more townhouse construction, and as I said, more remodeling. So the market is, by 2035, going to change in composition. Questions?
Are we at risk of losing our world currency reserve status to the Chinese yuan?
Sort of a general economics question. I have an answer, but I want to let.
Yeah, well, I'm going to guess we don't differ very much. I mean, the likelihood of us losing it in the near term is pretty low. There's simply not a good alternative to it. Continuing to run huge deficits increases the risk to us because the dollar becomes less stable. And if you look at returns to the financial markets over the last year, much higher outside the US.
Yeah.
I mean, it feels good in the US because they've gone up, but they pale by comparison with what's happening everywhere else. Not a good sign. And then add to it the digital currencies and who knows? So are we, are we at risk? Yes, in the same sense, we're at risk from these growing budget deficits. Slowing down, your term, shallowing it out would certainly slow down that concern, but nothing in the near term.
They always say, if you don't know the answer, wave the American flag and exit the committee room. That's about, never bet against the US Constitution. So that's sort of the first part of the answer. But the second part is the Chinese really don't want to hold the world's reserve currency, because to do so, it's got to be fully convertible, which they have capital controls. When you go and you get a Chinese currency, you put it in a bank, same with India, you can't pull it out automatically like you can with US dollars. And if you do have the world's reserve currency, almost by definition, based the way global trade works, you have to run a trade deficit. The Chinese don't want to run a trade deficit. So what they want to do is pick away and provide some backup insurance policy options so they don't get, so what happened to Russia doesn't happen to China in the future, particularly with Taiwan, which could be an issue here in the next couple of years. But they don't want to be the world's reserve currency, which is why they're going through this BRICS thing. It's impossible. They have to have a free market currency backed by rule of law, and they don't have that.
Yeah.
So why would anyone ever trust their currency in it? So that to me says the US dollar will weaken, which is what's happening because of tariffs. But I don't see its replacement. I think we're on the same page. Dan?
Tough question.
All right, here we go.
With the big incentives right now to build to rent, a lot of communities right now across the country, a lot of them are doing a build to rent type of program. Obviously, 10 years from now, that's going to have an impact on generational wealth, because most people that now are moving up through the home buying process, they're using the wealth that they generated from their existing home and now are using it to buy into a new home. What's going to happen, and you didn't have a chart necessarily that said what's going to happen to the generational wealth, how much is that going to have an impact on the ability for somebody to go buy a home in the future then?
Yeah, so I did a lot of my graduate school research on the impacts of home ownership, social outcomes, community outcomes. One of the clear ones is the wealth effect. So when you look at the Federal Reserve Survey of Consumer Finance data, which is a wealth survey that comes out every 3 years, for a similar age household, a homeowner has 40 times the wealth that a renter does. And it's because of the forced savings that occurs through an amortizing mortgage. So you're right, as if there is a group of younger individuals who are going to rent forever, they're going to miss that wealth generation even with 401k items. Our consumer survey research says, though, that Gen Z has the same aspirations that prior generations does. So we shouldn't confuse a lack of means in terms of the available inventory to get into housing with a lack of wants. They want to be homeowners, they want to get married, they want to have kids, they want to do all those similar things. But you're right, the wealth accumulation will be smaller. But in the meantime, single family built for rent, so construction targeted for rental housing, historically was about 3%. You can see here it could kind of go into the 90s, and then it takes off. So this is kind of the trend that's kind of builders have kind of latched onto. Right now, it's probably closer to 10% of single family building. We think that's going to continue. This kind of triple the ordinary market share. So there is this demand for it. There's a consequence from it. And I will say, one thing I push back in DC on is this idea that big financial institutions are going and buying homes, and that's causing the housing deficit. That's not causing the deficit. The deficit is the mismatch in stock with the number of households. What it is doing is crowding out the opportunity for those people to own a home rather than rent a home owned by somebody else.
Segueing that question.
Yeah.
Obviously, and 20 years ago, the majority of the builders were single family builders that built anywhere from 8 to 10 homes on average. Now that demographic has changed. We've got production builders that have moved into areas that are doing that, and then also producing the same level of homes and a higher number.
Yeah.
But that also is having that same impact on the generational wealth, is it not?
And one of the things I really like working with NAHB is that we defend the American dream, homeownership, but we also, work in an industry that really has a large number of small businesses. The evolution of the industry in terms of builder size has been interesting. So you'll hear a stat that the big builders are 50% of the industry. That's not actually accurate. They are 50% of home sales. But home sales is only a subset of home builds. Home builds includes built for sale, and includes custom built, contract built on an owner's lot, and built for rents, this other component. So the top builders right now are about 30% of construction. Now, in the late 90s, they were like 8. So they've absolutely gained market share. They're good at the planning community. Scale economies is one great way that we're going to add housing supply. I'm sort of let 1,000 flowers bloom sort of in the garden approach. But here, I'll give you a contrarian forecast I know my counterparts at Zonda and John Burns probably will disagree with. I think we're probably going to reach peak big builder share in 2031, and then it will go down because master plan community growth is going to go down because of the demographics that we talked about. Tear down construction right now is about 8% single family home building. A decade ago, it was closer to 4%, and that share is going to continue to go up. That kind of construction is a smaller community builders. So we need builders of all size, including apartment builders, built for rent, built for sale. We've got a really kind of interesting industry, but there have been changes in concentration. That's right.
And then adding to that is what NAHB is doing to try to incentivize the first-time home buyer and those programs that could be coming forth for individuals that don't necessarily have the generational wealth, but need a kind of a leg up, whether it's a lower interest rate or a buy down interest rate. What is NAHB doing specifically, and how are we advocating for the first time home buyer?
Yeah, the lobbyists looking at the demand side of the market have come up with a variety of issues. Now, a lot of them are focused on the supply side, trying to let builders buy or build more entry level homes. There was this discussion of a builder tax credit if you build certain kind of housing that would be targeted for first-time buyers. That idea has gotten a warm reception, but it hasn't gotten a lot of legislative movement. One idea that's out there is to take what's left of the mortgage interest deduction. Back in 2016, more than half of homeowners claimed the mortgage interest deduction and benefited from it. After the 2017 tax cuts and the doubling of standard deductions, now 10% of taxpayers benefit from the MID. So one idea is to take the tax expenditure amount from the MID, take that money, get rid of it, and turn it into a dedicated first-time homebuyer tax credit that can be monetized at the closing table to provide a down payment. We were real big on that idea. It was probably a bridge too far, particularly for some folks in housing in California that still disproportionately claim the MID, but that idea is floating around. And then Director Pulte, who's had a lot of, we'll say, interesting ideas the last few weeks. If you need to follow somebody, he's the Federal Housing Finance Agency Director, very active on Twitter. He's just throwing stuff against the wall. Some of the ideas are a little out there, and some of them are there. I encourage his enthusiasm. But he proposed about, it was a month ago, the idea of a 50-year mortgage. I don't think that's a particularly great idea, but as I was telling folks in Denver or leadership meeting, I was like, I bring some buyers to the market, but build up equity slower, and that equity is the down payment on a move-up purchase for new construction or for remodel. So that's not a great idea. At least they're thinking about it. So there's a lot of ideas in DC. What we need is, frankly, though, from my perspective, supply sides.
That will help in the debt ratio qualifying a little bit for the first time home. Not much, but a little bit.
A little bit. The big challenge is if you run the numbers with a 50-year mortgage interest rates would have to be like 75 basis points higher than a 30-year mortgage to get investors to buy that instrument. It's not much of an impact. And as I said, I think the primary constraint on home buyers is the down payment requirement. With that price to income ratio of 5 to 1, it's a lot harder to save. But there's a lot of debates. The important thing, as we like to say, is you got to have a seat at the table, otherwise you're on the menu. And so, having a seat at the table is really important for those kinds of policy debates.
And Rob, just for the last thing, just share with our members in the room what our lobbyists really are working hard now in DC to be able to help with all the issues that we're facing under housing affordability and then also the regulatory side.
Yeah, so our chief lobbyist probably would not like me talking about this because this is more his sandbox than mine, but I will say that, they're really focused on making the argument, as I said, on that CPI inflation side, that the only way to bring inflation down to 2%, the only way to address some of these other issues like falling demographics is additional housing supply. And in the new Washington, the way that you do that, you got to get directly to the White House. The old game of, sort of lobbying individual members of Congress is important, but it's really about the White House. So, what our lobbyists week to week are trying to find those important contacts, kind of move the needle. My particular job is to help lobby the Federal Reserve. You don't really lobby the central bank, but that's sort of what I do. But they're working on regulatory issues. They're working on tax policy. Like I said, there's about 100 of them every day working on your behalf. And, that's the value of our industry. We've got, 3 million individuals in this country working in residential construction. That counts for something in terms of electoral politics. So it's really important. So, thanks for asking that. All right, I will make sure my slide deck's available to the HBAGK team. It was great to. Thank you.
I give a big round of applause to Dr. Fox and Dr. Dietz, obviously. Great information. Those of you that are members, you can get a copy of these slides that we have. Those are provided to our members at no charge. Those of you that are not members that want a slide, come and see me. I'll sign you up as a member and I'll make sure you get them as well. I do want to take the time to say again about membership. It is very important. And I can't stress it enough. Your membership does go a long way. And it is members like us that make a difference. And it does move the needle legislatively. So continue to participate in the home builder side. Those of you that aren't members, if you want to talk to me individually, I can tell you all the benefits. And I can tell you 30 different ways that I can have your membership pay for itself and actually make you money. I know that sounds crazy, but it does. The membership that we have with NAHB at that level, your local level, and at the state level, there's so many incentives out there that if you do become a member, it pays for itself tenfold. Not only that, you get to come to things like this and participate and get a lot of great knowledge. And again, I want to thank all the staff for doing this. And this one special lady right here, Tracy Linderman, I'm going to put a plug in here from ORNL. Give her another big round of applause. Builder members here